Is the SUD Life Wealth Creator Plan your gateway to long-term financial growth, or are there smarter alternative investment options to explore? Let us find out through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. So this is an unit-linked life insurance plan, and some of the key features of the policy are: it provides diverse investment strategies with multiple fund options, it offers flexibility to modify the premium payment term, it allows fund switching and partial withdrawals for liquidity, adds an extra allocation of 1% of the annualized premium to the fund starting from the 11th policy year, and refunds mortality charges, enhancing the overall returns of the policy. So these are the key features of the policy, and there are benefits like death benefit, maturity benefit, return of mortality charges, and extra allocation. But as a ULIP policy, there are also various charges that will be deducted from your policy, like premium allocation charge, policy administration charge, fund management charges, surrender charges, switching charges, partial withdrawal charges, and mortality charges. So the charges imposed under this plan acts as an additional burden on the investor. Unlike most equity-based investment avenues that have minimal or no such cost, these charges can steadily chip away at your returns over time, reducing the overall wealth you could have accumulated. Some of the advantages of investing in this policy are: there are partial withdrawals permitted from the 6th policy year onwards, or once the life assured turns 18, whichever comes later. So the policyholder has the flexibility to increase or decrease the premium payment term. A settlement option is available for the death benefit. The policyholder can redirect premiums and switch between funds as per their preference. So these are some of the advantages. However, there are some disadvantages, like no facility available under this policy. Top-up premium contributions are not permitted. The sum assured may fall short of adequately covering protection needs. The net premium is invested only after deducting charges, reducing the effective investment. And funds remain locked for the first 5 policy years, restricting liquidity. So overall returns are less competitive compared to alternative investment options. So these are some drawbacks that you need to keep in your mind before deciding to invest in this policy. Now, as we have a basic understanding about this policy, let us now move on to the analysis part of the video, where we are going to conduct an IRR analysis to help us make a more informed decision. But if you do want to understand certain aspects of the policy in detail, you can refer to the policy brochure. So now, to help us calculate the internal rate of return, we are going to do that based on the policy brochure's benefit illustration. So for calculation purpose, let us assume that a 35-year-old male has purchased this policy with a sum assured of 10 lakhs, a policy term of 20 years, and a premium payment term of 20 years. So he pays an annual premium of 1 lakh. By paying premiums consistently, this policyholder becomes eligible for the fund value at maturity. However, here we have given an example return assumptions of 4 and 8% per annum as per the policy brochure, which are neither guaranteed nor reflective of the actual market performance, which can vary based on several factors. This is just to show you how this policy returns can perform at both extremes, which is the worst case and best case scenario. So at a 4% return scenario, the fund value is 24.86 lakhs with an IRR of 2.03% as per the policy's maturity calculator. At an 8% return scenario, the fund value is 38.66 lakhs with an IRR of 5.93% as per the policy's maturity calculator. So even in the higher return scenario, the IRR remains subpar. So for a market-linked product, returns are expected to beat inflation, yet this plan fails short compared to other equity-oriented investment options. So beyond low returns, the sum assured is insufficient, and the plan comes with high charges, limited transparency, and low life cover, making it an unattractive choice for long-term financial planning. So as this policy is not giving us a desirable outcome that we need, which is an inflation-beating return, we are going to do a comparative analysis here, where we are going to explore an alternative strategy in which we are going to use the same premium of the SUD policy but that we are going to split it and invest in insurance and investments separately. So let us analyze the same metrics as in the previous example for a much more fair comparison. So for life cover purpose, we have taken up a pure term insurance policy with a sum assured of 10 lakhs, which cost us an annual premium of 4,900 rupees with a policy term and premium payment term of 20 years. By opting for this, instead of paying 1 lakh annually into the ULIP, an individual saves 95,100 rupees per year, which can be invested based on risk preference. By channeling the savings into suitable instruments, investors can align their portfolio with their risk appetite. So high risk investors can allocate funds to equity based instruments, while risk averse investors can opt for debt instruments. But here in the tabular column presented on the screen, we have considered both scenarios for your easy reference. So in the pure term plus PPF combination, the final maturity value comes around 42.21 lakhs, yielding an IRR of 6.68%. So despite being a debt instrument, PPF outperforms even the 8% return scenario of the SUD policy. In the case of pure term plus equity mutual fund scenario, the pre-tax maturity value is 76.74 lakhs, and after accounting for the capital gains tax, the post-tax value is 69.68 lakhs, resulting in an IRR of 10.82%. So this return comfortably outpaces inflation and supports strong wealth accumulation over the long term period. So if you do want to know how we have calculated tax for equity mutual fund, you can see that we have presented a small tabular column for that purpose in the screen for your easy reference, which you can pause and see. So by separating insurance from investment, investors can achieve better risk-adjusted returns, higher transparency, and greater flexibility. These are the critical elements of sound long-term financial planning, elements that the SUD plan fails to deliver. So what is the final verdict then? Is investing in the SUD Life Wealth Creator plan worth it or not? So this policy is essentially a standard ULIP plan. While it provides exposure to market-linked investments, a closer look shows that its returns are relatively low compared to other market-oriented options. For long-term wealth building, investments are expected to deliver inflation-beating growth, yet despite its name, the so-called wealth creator, it fails to create meaningful wealth over time. High charges limit its growth potential, and the plan struggles to even outpace inflation, leaving you technically and financially short of your goals. So on top of that, sum assured is inadequate, making it unattractive from both an insurance and an investment standpoint, and it also has a high agent commission. So a smarter approach is to separate insurance and investment. A pure term life insurance policy offers you the most cost-effective way to protect your family's future. For wealth creation, it is better to build a diversified investment portfolio tailored to your risk appetite, financial goals, and time horizon.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.